So we're joined today by Chetan and Trehan to host a session with David Wilson of JANA and Veronica Klaus of Lonsec Evidentia to talk about what it really does take to run in-house portfolios and to have licensee-based portfolios. So please welcome Chetan, David and Veronica.
Thank you, Toby. Afternoon all. Hope the session's going well for everyone. So this session, as it says, it's about pros and cons of in-house managed accounts. I'm Chetan Trehan from SQM Research, sector head for multi-assets, real assets, and alternatives. We'll start with brief intros and then get into it. Veronica.
Thank you. So I'm Veronica Klaus, now part of the Evidentia group, and I'm Deputy Head of Consulting.
Yeah, and David Wilson from JANA, Senior Consultant, focused on the wealth market.
Great. So, pros and cons of in-house managed accounts. Let's get sort of brief overview, overall thoughts, and then we'll get into some of the detailed conversations. Pros and cons of according to you, in-house.
It's almost going to be an easy one, isn't it?
Yeah.
Look, I mean, I think just to set the scene, you know, Evidentia Group, obviously, you know, following the merger with Lonsec, offers both a combination of public or retail as well as tailored managed accounts across SMA and MDA. So, you know, I definitely think that there are definitely a lot of positives or pros to building out a tailored space, and I would say that because that's the side of the business I'm on. But I do think that you know, there are sort of guidelines around who they best suit. You know, and I'm sure with some of the questions that we'll delve into that a little bit more. But you know, without a doubt, I think for groups that are of reasonable size and you know, have got very certain expectations around what their clients need, then they're a very, very, they're a great way of building a solution to clients. I think what needs to be said right from the outset, though, is that managed accounts and the move to managed accounts is all about business efficiencies, right? Yes, it's about building an ideal investment solution, but even for those that are in tailored, it is all about how you're bringing efficiencies into your business. So I think that having that very clear focus for any group is key.
Yeah, I think, as Veronica said, as people or businesses that provide managed account services, you're not going to get too much argument from either of us probably, and I think we were discussing that before. Our business has largely been focused on that tailored experience, taking the work JANA has done in the institutional space, you know, real partnering with clients and bringing that to the wealth market. Now there's certainly pros, and I think even some cons, which we can touch on in terms of managed accounts. Obviously, business efficiency, you know, governance, you know, consistency of outcomes. Assuming you get proper buy-in from the advice practice, is certainly on the pro side. And then I think there's some cons that we maybe don't spend enough time on. You know, resourcing, it can be challenging setting up an in-house program. It takes potentially longer than I think what some people expect. And then there's things about, you know, being able to, inevitably things are going to go wrong, particularly in terms of performance, and being able to, you know, be accountable for that and be able to, you know, speak to your client base. You know, the kind of things we need to think about when setting up programs.
Okay, thank you. Any other cons? I mean, there are lots of pros, Veronica. Any other cons or disadvantages you can think of?
Again, I don't think there's so much as disadvantages. The ones David's touched on. I think what's really important is when you're building a tailored managed account, though, it very much forces a business to really think strategically about what they represent to their clients. And, you know, a lot of time, you know, you're really having to work with them to help navigate through the process of even just articulating an investment philosophy that is carried through the governance framework for their construct and then to the conversations that they have with their clients. And so sometimes, you know, it can be the expectation at the start is, this is what my models look like, let me just build it, or let me just, this is going to be, you know, easy. But there is a lot more work. And I think even once you've built your managed account, unless you've got a program in place to actually be able to effectively transition your clients into a managed account, then, and people tend to ignore that. There's no use building a product and not being able to transition your FUM into it, right? Or even only being able to transition, maybe less than 50%. You don't get any of those efficiency gains. So you've increased the amount of work you're doing, but with no gains on the other side. So I think it's not really a con or a disadvantage, but it's more about you need to very much think about it across the board and say, I can build the investment portfolio, that almost becomes the easy bit, but how do I ensure that I have appropriate integration across my whole network of advisors, across my whole client base as well? And that can be a real challenge for some groups.
Right. Overall, would you say it's viable for most dealer groups, licensees, and a couple of things that they need to think about versus off the shelf?
Yeah, again, it comes down to your FUM size and what you represent. There's obviously going to be groups that they are too small to build a tailored. So they've still got opportunities to use managed accounts, but it's going to be a retail offering. But for definitely groups that are a reasonable size, and as I said, actually want to get a consistent philosophy across all of their clients, then it is a very, very effective tool.
Yeah, no, I'd agree. I think not only is it viable, I think it's becoming increasingly vital for groups, as you said, of a specific size or a minimum size, to be able to access those efficiencies. We know there's less and less advisors year on year, so the ability to access those efficiencies and work with, grow businesses, work with a number of clients, and find the efficiencies in various avenues, this being one, I think is incredibly important. Not to illustrate a competitor, Toby, but I was at a conference yesterday and they had a poll up on the screen, and what the first question that came up was, what are you worried about over the next 5 years? It's about 40 or 50 advisors in the room, and the options were along the lines of staffing, business growth, regulatory risk, but the one that was far and away the top answer was technology and efficiencies. And I think that's what we're seeing in the industry, and I think that's obviously front of mind, and a lot of the discussion here today is on that.
Yeah, interesting. Let's talk about some of the nitty-gritty of the operational part of it and investment decision making. So thinking of investment committees, how involved are you? What are the different variations in terms of how much the client wants you to be involved in terms of that decision making process overall?
I think there's a couple of different steps before you get to that. First and foremost, when we're partnering with a client, we're partnering with a group where there's synergies around thought processes, right? So that's really, really important. So when we go into the build phase, typically we act as the investment manager. So for most platforms, that means that we will have either veto or some, if you're going to get technical around voting rights. But in saying that, we have very rarely come across a situation across any of our clients, and as I said, now I think I've got Lemo somewhere here that could correct me, but I think we've got something like 40 clients across the Evidentia group just in the tailored space. We very rarely come across a situation where there's disagreement, right? Because it really comes down to the relationship that you're having with your clients, the conversation that you're having leading into any investment committee around, the portfolios and what they believe in and what the construct is. So sort of there's the technical side from a voting perspective and what the REM platforms need, and then there's the reality of how you partner with your clients and what that means.
So not too many vetoes from your side?
Never.
Not like the UN
We
Security Council?
have never had to veto. So it's that, and that's the honest truth. So
You've been lucky, we have.
really?
Once or twice. I think, for us it varies client to client. When you think about the types of clients we work with, they tend to be at the larger end of the spectrum. So they somewhat resourced in terms of the investment committee and internal investment teams. So the structure and the way we work with clients from an investment committee perspective changes. From one end of the spectrum, we are running portfolios, we're essentially running the committee as well, all the way to the other, and we're just an input into the committee. And I think we're across that spectrum, we're fine as long as going into that process, everyone's comfortable with what their roles are. It's pretty well defined in terms of the decision-making process, and we know everyone kind of knows where they stand.
So you're happy to be either end of the spectrum? Okay.
Yeah, absolutely. I mean, what's most important for us is good sound decisions are being made within that kind of tight governance framework. How those decisions are made is up for discussion, but as long as good decisions are being made, then that's important.
Yeah. I mean, debate is healthy, but that's very different to vetoing a decision.
Yes.
And I think we can honestly say that we have rigorous debates, especially in fixed income at the moment, across a lot of our clients. But that's what you want, so that you do, because again, it comes down to ensuring that you're getting buy-in into the portfolios. At the end of the day, we're constructing portfolios with our clients, for our clients. They're not for us. So, and who knows the end client better, them or us, right? So you need to be very, very respectful of their views across the board and what they bring to the table in an IC.
Yeah, I think that's an important point. I think we go into any engagement with clients saying, these are your portfolios, they're not ours. And the way we work with the business on that is it changes, but at the very kind of core of it is that licensee's product or fund or portfolio. It's not ours, and it has to be suitable for your underlying client base. As you said, the clients, we don't. So you tell us what it needs to look like, and we'll kind of go from there.
Yeah. And in terms of the underlying funds being used, do you get many requests from the clients that we like these few funds? And
absolutely. I mean,
most of it should be my way.
Look.
Global equities,
We all know that there's 5 million BDMs out there knocking on everyone's door, and we'll often get calls from our clients saying that they've just met with a particular group and that sounded interesting. What are our views? But that's what we're there for. We always talk about the fact that it's a holistic relationship with our clients. It's not just about looking at the SMA and no other discussion. But so I think that without a doubt, no one has got. No one is sort of the convener of good ideas. Everybody's in that IC to bring together different views, different ideas, whether that is funds, macro views, it doesn't matter. It's around the discussion that you have around about it. I mean, sometimes we'll have portfolios that we're, especially that we're transitioning across into a new build, and there might be a fund in there that may not be one of our preferred. It may still be very well regarded, but just not a preferred, but the client's got significant FUM. We underestimate how important incumbency is when you're building out managed accounts. We also underestimate how important it is the conversation that the advisors have had with their clients around build. And, for example, we've got some groups, and to pick a fund manager here, which I wouldn't normally do, that for example, are very wedded to say the dimensional approach, and they've always used that. They very much buy into that value approach. Well, we're not going to dictate that should change. We're fully supportive of that, and we'll build portfolios around that, because for them it's about the consistency then once they move into a managed account, that they continue on with that philosophy and the same names. The transition from a model to a managed account is a big enough shift as it is. The last thing you want to do when you're building out is turn around and have the advisor say to the client, number one, we're moving to a new structure, and number two, all the previous funds you've invested in are rubbish, we're going to start from scratch and here's a whole new lot. That's not the way it works. It's about transitioning a model that's being used and building it out into a managed account structure to give the business efficiencies. And that for us is always our first step when we're engaging with a new client.
Yeah, no, I completely agree with everything Veronica said, even to the point I had an existing client a couple of weeks ago who asked us to build a new set of portfolios. And within the request was, this is a blank sheet of paper, start from scratch, to the point where I had to go back to them and say, are you sure? Like, you really mean that? It turns out it was, so this very rarely happens. There's usually, as you said, incumbency, CGT, whatever it might be, reasons that there isn't a starting point, and we work with clients as well to transition from 1 to 2. It might take 6 months, one financial year to the next, whatever it might be.
Yeah, and that's a really great point, because sometimes the client that's had a model portfolio for a long time will say, okay, if you were starting from scratch, build that, and this is where we're at. And they then go away as a business and say, what do we feel comfortable with as a business transitioning to? And more often than not, they'll say, look, we want to start here, but how long would it take us to move to there? And so there's multiple different ways that that we work with the clients.
And speaking of clients, talking to their end investors or clients, do they normally mention you? Do they keep you in the forefront or background that we love JANA or Lonsec?
It varies, right? Again, we have some clients who are very keen to push JANA to the front and say, we're leveraging off the same research engine and portfolio construction engine that the large super funds are doing. We're leveraging off the 110 researchers running around the globe doing 3,000 meetings a year. Don't know how they do it, but they do. We have clients that really push us to the front, even to the point where we'll go and present to their clients. And then we have others who just really want to keep us on the back. And just keep that kind of engine a little bit quiet in terms of who's really constructing. And look, we're fine with either approach. As I said at the start, it's their portfolios, it's their process. Again, really all that's important to us, as I said, is sound, robust decisions are being made.
Yeah, I absolutely agree with David. It's the client's choice. I think what we find when you transitioning or building managed accounts is they do tend to like to bring the consultant to the forefront so that they can actually show that they've engaged a specialist group to assist, and that sort of adds some levitas to that transition. But yeah, it's definitely up to the client as to how they go about that conversation.
Okay, interesting. Let's talk about asset allocation a little bit in risk profiles, SAA. How many clients would want you to be more active in a TAA, DAA scenario, and so how many would not want that?
I think, so we don't do TAA. We think that kind of short-term timing is a bit problematic. It's extremely hard to do. I think what we see, particularly from a DAA perspective, I think clients want to understand that they're getting value for money is the wrong term, but I'll use the term value for money. And that when we're making decisions, particularly around DAA, we're standing behind those decisions. They're robust enough and they're significant enough to kind of move the dial. Moving 1% here or there doesn't really kind of fit the bill for what clients are looking for. It's really is if you're going to make a decision, stand behind it. And for essentially all our clients look to undertake a DAA approach.
Yeah.
We think there's value there, particularly at times at the moment when there's incredible amounts of volatility around, uncertainty. There is certainly scope to add value through that kind of process.
Yeah, we're exactly the same. I mean, we've got an option. Clients can choose to use our DAA approach. Again, we don't do TAA for the same reasons David just articulated. I think that there's a natural expectation that when you move to a managed account, there's going to be more active management and oversight around it, and so that therefore extends to managing the portfolio especially for risks from an asset allocation perspective, which is where the DAA comes in. We've got a few that have an SAA approach only. Some of those are probably managed accounts that are built on some of the lower cost platforms, so it's more around efficiencies than anything else, and sometimes with a narrower platform it can be more difficult to implement some of the DAA views, but each client is able to elect what their preference is, but most would have a DAA.
And speaking of lower cost portfolios, you provide those sort of solutions as well. Is that increasing in demand?
Yes, this is a whole. How much time do we have for this conversation now? Look, I think that there's definitely a conversation that I tend to have a lot of times with clients is they really need to work on when they're moving to a managed account is what the driver is. So we'll have some groups that it's very much about transitioning existing models into a managed account. They accept the fact that there's going to be additional fees, even once we get the rebates out of the way, but once you add in the RE and the consulting fee, etc., there's going to be additional fees, but they want the synergies in the portfolio, or they want that process. Others will come to us and say, look, you know what, I'm less about the underlying funds. I need to make sure that the model portfolio fee that I have here, all in with the managed account, is the same, right? Again, we can work to that. It's about what the business needs. It's about what's going to drive their conversation with their clients and why the transition is occurring. We can build any type of portfolio you want. That's the whole point of tailored. Yeah. We've got passive strategies that have just got a DAA overlay. We've got fully active strategies. We've got some with alts. We've got some without alts. You name it. So, if we're given a fee budget, we can work to that. If we're not given a fee budget, happy days.
Yeah.
No. it's really what the client needs.
I mean, no, the only other thing I would add to that is I think it's a well-known fact that what this, the uprising of this managed account industry has meant is fees have come down, institutionalisation of the retail market, and we're clearly seeing, I mean, even in the last couple of months, the rebates that are on offer for managed accounts from fund managers, both domestic and large globals, are just significant. Like the gap is closing between passive and active. I think it's partly a reaction to losing money to passive. Active managers having to bring their fees down. But some of the rebates being offered are not closing the gap, or not fully close the gap, but are certainly closing the gap and making that active all-in fee much more palatable, which I think is probably driving a little bit less demand for purely passive portfolios. We're more seeing it as kind of maybe it's a core satellite approach. Maybe it sits in the managed account, maybe it doesn't. But just maybe bringing the fee down, but still having that kind of an active core.
I think what it's also doing, it's actually enabling us to bring that institutional lens way of building portfolios a lot more to the wholesale market. So you really can start to think about, where you want to pay for that sort of that active alpha and where you want to use your risk budget. And so you can be, I think, a lot more sophisticated in your portfolio construction to what we used to be able to be in a model portfolio that only really got reviewed when need be, or annually, or whatever it may be. So I think that sophistication is a really huge positive that's come to through via the managed account structure.
Yeah. And there are plenty of ETFs, obviously, on the passive side of things.
You could argue there are too many. Yes, there are plenty of ETFs.
So
there are ETFs for everything.
There are.
So there's no issue in finding in finding sort of cheap beta somewhere.
No, I mean, we use ETFs through some of our client portfolios where fees are a challenge. I think one of the things we've been pushing into is kind of that kind of middle ground. So enhanced passive is kind of an area we've been pushing into as opposed to kind of pure passive. And that's really, you're getting outperformance, theoretically, hopefully, at a very, very attractive fee point. And that's been a bit of a challenger to kind of pure passive investments more recently. Particularly with some of the issues around concentration and they're really unattractive investments at this point.
It just, as I said, it just changes your conversation. I mean, there are without a doubt certain times in the market where beta is very cheap. Therefore, it's most effective to bring in passive strategies and passive ETFs into your portfolio for your beta exposure. There's other times where it's not, and you want that active exposure. So you can have those conversations with clients, and you can really align the portfolio to that sort of the medium-term thematics that we're seeing in the market.
But even ensuring your passive exposures are fit for purpose, right? There's certainly asset classes, and I'm sure everyone in the room is aware, where you just don't want to be passive. Small caps, for example, emerging markets, A-REITs, all those sort of sectors where they probably don't lend themselves to a passive investment.
What about Magnificent 7 ETFs and NASDAQ ETFs? Would you go there, or does it need to be client-directed?
Yeah, look, we've never been massive fans on very specific thematics in most of the client portfolios that we've seen. I mean, we've got some clients that have got sort of very nuanced portfolios, and therefore they tend to like some of the more esoteric exposures. But overall, I think that when you're getting a very sort of explicit exposure to a thematic like that, you've got to be very good at timing, and it just doesn't align to our sort of views that we take from we don't do that TAA, and even our DAA is always a starting base is where are there risks in the portfolio, where are there risks in the market, and protecting the portfolio rather than trying to eke out the next little bit of return somewhere.
I mean, we're agreeing too much.
Can we start a fight?
No, I agree. We don't like those more esoteric ETFs. Smart beta type ETFs we don't use either. We tend to, for those sort of exposures, we'll allocate to active fund managers who target that space.
Yeah.
A lot of those conversations tend to happen around satellites that can blend with a managed account. And it may well be an investment committee, a client will ask us about, they might have a very high net worth portion of their client base where they do try and use different types of asset classes. So that's where we'll have a lot of conversations around some of the alternatives, private equity, private credit, et cetera, and we really bring into what's going to blend with your core portfolio or your core holdings. So some of those would fit into that.
Yeah. Wholesale investors versus retail.
Yeah.
How much demand are you seeing the other way? How different are the portfolios, if you want to target either, both?
I think where the differentiation is for us tends to be in that core satellite approach. So just by the nature of the clients we have worked with historically, and perhaps it's them targeting JANA because of our history and kind of that unlisted institutional space. We tend to find clients will try to kind of get most of their clients within the managed account structure, and then for those that are wholesale, they'll look to add sort of satellites, private equity, unlisted property, whatever it might be, as opposed to creating kind of a pure wholesale portfolio. It just kind of gives that additional flexibility.
I suppose at Evidentia we've got the benefit of having IPL and a MDA within our business. So we do have some clients, for example, we build a portfolio and it sits as an SMA and on the MDA. And so it can act as, to pick a number, 80%, 90% of their core exposure for most of their clients, and then maybe 40 to 50 for their MDA-based clients, and then we work with them around other strategies to blend with that. So I don't think it's about so much as building a wholesale SMA. As David said, it's around more of a portfolio view, especially for our MDA clients. So we do that.
And speaking of alts and private assets within the portfolios, obviously there are a few constraints around that, liquidity and platform requirements. Are you using a bit more of that? Are you unable to use it mostly?
We want to keep our SMAs at daily liquid.
Yeah.
I know that there's some platforms that are starting to be able to cope with up to monthly liquidity, but we've just found that it's cleaner, especially when you're rebalancing, to have daily liquid strategies in your SMA.
Yeah, we have one or two clients that include what was historically monthly priced private equity, which is no longer monthly priced. We have some clients that have gone down that track, but generally, just for simplicity's sake, keeping it daily liquid until we see kind of advances in the platform technology, which I think is coming. It's much cleaner, it's much simpler, and much easier.
Let's briefly talk about ASIC and regulatory framework overall in the managed account space, just sort of lighthearted conversation, and the performance test that might be. So what are you seeing there? What's
I mean, we're watching it. It's clear something's coming. What it looks like is still up for debate or consultation. Look, from my perspective, anything that lifts the industry, lifts the governance around it, lifts the performance outcomes, the client outcomes, is a positive. Now, a little controversial, someone who spent recent 3 years of their career within a super fund dealing with the performance test, I have some insight into the behaviours it drives, and whether that would work or whether that's a positive in this space, I would probably question, without being too controversial. But yeah, anything that lifts the industry as a whole and provides that kind of trust to the end users, I think is a positive.
I think, to a certain extent, I absolutely agree with David. And again, through our association with Super Ratings, they've obviously been heavily involved in this component. So as soon as it was announced, we spent quite a bit of time on how it would impact our portfolios and using sort of our retail ones as a test case. And it would create a lot more work. Let's not deny that we're trying to bring efficiencies into the system, and this would create complexities. I think from a personal perspective, I'm sort of not convinced it's the right way to go, because at the end of the day, the end client in this situation is an advised client. It's not like in a super fund where they're not. So I think if it forces portfolios to look more and more like a benchmark, that's not a good thing, especially considering most end clients go and seek advice as they're nearing retirement, and retirement portfolios are not about matching a benchmark or matching an SAA. So I would hope that if this comes in, it doesn't move us away from the value of giving retirement advice to clients.
Yeah, interesting space for sure. One eye on the clock. just a quick comment on technology, what's been changing over the last year or two in your teams and how you use technology and help the client.
We were talking about this just before we came in.
Yeah.
AI, without a doubt, I think is a great tool for most businesses. We're spending a lot of time on AI integration, just with so far as how it can help around, commentary and really bringing efficiencies into reporting and those types of things. So, Evidentia's been spending quite a bit of time on that. I think, that's what we're going to see that next wave of efficiencies come in for I think our business in particular.
The first step for us has been through the research process, like writing research reports, gathering data, all that sort of stuff. We haven't seen too much on the portfolio construction side, but we've got kind of internal projects going on at the moment, leveraging resources, trying to figure out, what is the best use of technology. It changes so quickly, but it's certainly going to be a bigger part of all of our businesses. It's changed the way in which we work, the way in which we prepare for panels. It's also changed that. So it's made it easier. But yeah, it's a changing world.
Yeah.
Yep. Okay. Good. Toby, you're going to do
many of you will be involved with or thinking about in-house portfolio management. Are there questions for two of Australia's leading organisations involved in the creation and customisation of managed account portfolios for practices? Because I have one which I didn't hear the phrase conflicts of interest come up too much in this. So what's your experience in the way that licensees and advisors think about whether having an in-house portfolio creates a conflict of some sort, and the way they might kind of either rationalise or deal with that issue?
Look, we don't typically work with groups where a fee can be taken by the licensee. So I think once you enter into that side of things, unless you can very clearly articulate what that fee is for, that's when you tend to start to get into the murky waters of conflicts. I think if you've appointed a group, whether it be sort of JANA or Evidentia, and they're building a portfolio on your behalf and you're providing time and resources through being a part of the investment committee and the process, then there's no conflict to be had with that if no fee's been taken by them. So I think it really depends on the structure around that. And you've got to, we don't see anything where there's, push for product, that might be, the next door neighbour's dog's running a mortgage fund and they want that thrown in, and that may have been back in the 90s, not anymore. So, you need good quality research that underpins all of your portfolios, and, I think we're stringent around that. The RAs, the platforms are stringent around that. And at the end of the day, every single group that we work with is stringent around that as well. So.
No, I'm sorry. I think answer to the other thing I'd add is due diligence is a two-way street. We do ours on potential clients we want to work with, as they do on JANA as provider.
Yeah.
Other questions for Leanne? Yeah.
I just had a question about implementation of DAA. How do you both currently implement that? Is it through buying and selling of units and securities? Is it using particular vehicles, structures, ETFs? And is there another way that you don't currently have access to that you would like to be able to implement that sort of?
I think it depends on the view. Typically, because our DAA is sort of that 6 to sort of 18 months, you're not needing to go and find, very cheap investment sort of vehicles or instruments to be able to implement a view quickly. So you've usually got time to establish it or to build it out. If I look at one of our views where we're currently overweight Australian duration, yes, you could go and get a passive strategy to do that. We've actually made the call that we believe it should be active. So we're looking for the right manager to implement that. So again, I think that's more important for TAA to be able to have different types of instruments to implement. DAA is probably a little bit different, but I mean, sometimes it is a case of using a passive strategy because it's a currency position, it's a hedging position. But more often than not, you'll find it has to align to the client's need and what their portfolio represents as well. So,
No, similar response. It's currently using individual strategies within the portfolios. I'd love to be able to leverage some of the work we do with our superannuation clients around options and the like, but unfortunately that's just not feasible at this point.
Please join with me in thanking Chetan and Veronica.
Thank you.